Hi everyone, hello from Singapore. Thank you for taking the time to join us for today's event on investing with VCs and CVCs in Southeast Asia. My name is Jody and I'm from SGInnovate, and for those of you who may be more new to us, we are a global investment company set up as a private entity and funded by the Singapore government with a mission to build deep tech innovations from Singapore and for the world. We do so by investing in and helping to build deep tech startups in the fields of artificial intelligence, medtech, quantum tech, and increasingly we're also looking into new areas such as urban solutions and sustainability, advanced manufacturing, and food and agri-tech. We also work closely with entrepreneurial scientists and clinicians to help bring their innovative research from lab to market, as well as develop deep tech talent and engage with the vibrant deep tech ecosystem. Part of our initiatives to strengthen the ecosystem and generate conversation and knowledge sharing is through community events such as the one that we have today. Today's webinar will be on investing, and we'll start with individual presentations by our speakers Sheng from Qualgro and Shannon from MDI. We will then move on to a compare and contrast section with our moderator Benjamin, who will help to facilitate questions from the floor. Without further ado, I'll now like to pass the time over to Sheng to start off with his sharing. Sheng, please.
Hello, everyone. Hang on a second while I set up my slides. Can I see?
Yes.
Yeah, okay, good. So let me go along with this. You're still seeing my slides, right?
Yes, we can see the slides.
Second. Okay, good. So hi, hello everybody. My name is Sheng. I'm an investor at Qualgro. Along with my colleagues, we invest mostly in Southeast Asia and Australia and New Zealand, where we do active deal sourcing. We have a particular focus in data and software and in AI startups. We keep some flexibility for investments into areas outside of our core focus. We invest across the pre-A, Series A, and Series B stages. Again, maintaining some flexibility to either go in slightly earlier or slightly later. Naturally, the criteria that we are looking for in different stages are different, which I'll get to in a bit. But it's not so much that the criteria is different. It's more so that it's the same set of criteria, but with different type of emphasis. So this is in a nutshell. Some areas that we have taken a deep look at or have invested in are agri-tech, healthcare, marketplaces, robotics, fintech, edtech, supply chain. We may not have invested into certain areas, for example, agri-tech and healthcare, but we have looked at a few models in these areas quite deeply. But just haven't put the trigger on any investments in these areas, but I've done so in those other areas. So I'm just going to jump straight into some of the questions that we want to answer today, which is more around how VCs and CVCs think about investments. I think most VCs take a thematic approach to investing. It can cut across geography, it can cut across industries, or some sort of life cycle stages that they are looking at. One of the aspects of fundraising, let me just jump into, is especially if you are unfamiliar with doing an institutional round. On geography, you want to be sure that the VC you are getting on board has strong networks in the region that you want to focus on in the next few years. At some point, hopefully your startup will grow a lot and outgrow your VC, at which point you will bring in some other folks who could unlock new opportunities for you. And these networks can include business relationships with potential clients, with suppliers, with attracting talent, with future rounds of fundraising, or these networks could be just experts that could help you to crack a certain market. For example, in terms of suppliers, Qualgro has a strong relationship with large cloud providers that can help our startups to access certain credits very easily. Definitely do the desk work, but during your meeting, definitely ask your VC to go into some level of detail on these points. What are they focusing on, and why do they focus on this key areas that they are focusing on? Like I said, most VCs take a thematic approach. For us, our expertise is mostly on software, data, and AI. If your startup does not have these elements right now, I think it's fine. Still take the meeting. You never know when someday you might pivot into an area where it becomes more relevant for that particular VC. And by then you will want to have a relationship. So it's good to start early. This slide is kind of like a high level overview or summary of the things that as a VC I'm trying to get a grasp on, right? For Qualgro, by the time we submit a term sheet, I want to have a view on almost all, if not all, these items. And just to note, different VCs kind of operate differently. Some are very comfortable with knowing less than 50% of these before the term sheet, or even after the term sheet, is a function of having different types of risk rewards, which are in part influenced by different life cycle stages of investment. I'll get to that in a while. On this slide, for a very good reason why team is on top is because I think it's probably the most important aspect of any investment, and the importance kind of increase with as the stages of investment go earlier, right? On team, we can be looking at a variety of things such as experience, execution, ethics, openness for input, some of the things that we have mentioned here. But not only these things, right? These are, kind of like high level, more generic stuff. Most institutional VCs would have their own scoring system, even for, they would keep kind of like a systematic check on how they would assess founders. And internally, I think most VCs will have certain models of entrepreneurs that they prefer. So one of the tips I can give is, definitely ask a VC what traits he or she looks out for in an entrepreneur. And the answer may surprise you because it can differ from, people to people just because of different experiences. So personally, my criteria has sort of evolved over the number of deals that I've done. One thing for me that is super important when I, meet a new entrepreneur is I'm trying to assess whether he or she has the ability to see opportunities when some other people may see obstacles. And it may sound very abstract, but VCs have the luxury of seeing, how numerous entrepreneurs react to the same circumstance. And one very quick and recent example is, of course, COVID, right? It affected everyone. And we see many good entrepreneurs saying, okay, I'll conserve cash. I'll take a wait and see approach, see what happens, let the market settle. Hopefully things come back to normal, and then I'll take action again, which is very legitimate. And I respect that and logical. And I probably would have done the same thing myself. But we see also some exceptional guys who said, okay, in spite of COVID, let me try new initiatives to see what could work, right? My core business is suffering as a result of COVID. Let me try to find these other things because I'm now seeing new trends emerging. So let me try to put resources behind these. And in reality, startup space, this kind of exciting circumstances all the time in their own ways. And COVID just happened to be a circumstance that everyone faced, right? And how startups kind of react is driven, of course, by the founders. And hence this particular characteristic is, particularly key for me. Second, a very close second is we are looking at the market potential, which of course is important to VCs because all of us here are looking for outsized outcomes. If the market is kind of not large enough, even the eventual market winner, the leader, will not deliver a good, solid return. And we all know the story, right, of Uber's original target market. I think it used to be the high-end limousines type of on-demand market, which by construct was not a huge market. But it takes somebody who's insightful, who's imaginative enough as a VC and as a founder to partner up and say that, hey, this market is larger than it looks. And it can go into many other things. And it's not something that's easy to do. And many times VCs pass on deals based on an incomplete reading of the market. You also have the opposite mistake, right? Which is, thinking that the market is big when it's actually not. And this usually comes down to your understanding of market dynamics, and your understanding of market dynamics comes down to experience and just, in general, willingness to learn. And just as important, competitive advantage, you want to show why you would have longevity in this business. You want to show that today I may not have certain traits or attributes, but I can build on those, and those things will be valuable down the road. The next point here, traction, for me, it's more or less a shorthand to say that you have kind of executed well, and that has been demonstrated through traction. And some people say that in seed stage there's no need to look at traction because there's nothing to look at. Maybe there's something there, but I kind of disagree to an extent. So I think executional excellence can also be showcased in the absence of a long history of revenue traction, right? So for example, product traction is also a form of traction. So it's also an example, it's also a way to show you have executed well and you have progressed along nicely since your last fundraising now, and here's why. Raising this round of this new round will put you in a good place to execute for the next phase. Path to profitability is straightforward. I think there is an increasing there's an increased attention to look at profitability in general, to look at strong positive unit economics. Even if not today, but there's a trend towards and there's a plan towards getting those positive unit economics. I think the days of just growing for the sake of growing and then hoping that somebody will buy you or because you become too big to fail, I think that has that's not something that you can easily do now. And then the other things that VC generally look at are things like investment terms and exit potential, which are quite standard stuff. Terms would be your all your key terms that you will receive in the term sheet, which warrants a separate session altogether. And exit potential is more just for us, as financial VCs. At some point, we need to make a return for our own investors, and the only real way to do that is to have an avenue to exit. And there are many ways to do that, right? You can sell it to another company through a trade sale. You can do an IPO. You can sell some secondaries. There's a lot of ways to think about doing that, but shaping that exit and having a view on how a company that we are potentially going to invest in can potentially look like in 7 years' time or 9 years' time, or however you think gestation period would be, is quite important. Let me touch a little bit on this slide because I think it's important to understand the context of this slide in the context of this slide. So all these things here that I just talked about is relevant, but I guess to varying degrees on the spectrum of the life cycle stage of a company. When you are in the early seed stage and you want to raise money, if you somehow have come from you've done certain things, certain backgrounds, so you've been part of a very successful startup, people know you in the industry, it's very easy for an early seed stage founder to raise 1 million, 2 million in today's climate, just off the back of an idea. Maybe not even a PowerPoint deck, just because of who you say you are. For those of us who do not have that luxury, we have to work a little bit harder, maybe bootstrap a little bit, get some sort of MVP working, get some sort of traction going, and use that to kind of like parlay into an early seed round. And usually this round here is usually done by people that believe in you, and all of us have hopefully people that believe in us. So you get it from friends and family, for example. The other alternative here is to get this round done through. There are many well-established ones here in Singapore and also in the region, overseas as well. The most famous of this is Y Combinator. And of course, these guys here have a structure in place to help you get your company up and running, and you will be able to access some funds from here as well. So late seed, again, founder still critical, still thinking about how the founder is able to deliver, is able to execute. But usually, I would say that investors at this stage start to become a little bit more institutional, even if it's still some angels money. But you may have some of our seed investors starting to invest, and they would contribute. They will lead a round of, let's say, 1 to 3 million, with some other smaller guys following. And at this stage, I think every investment here needs to look like a winner, has the potential to winner. The concept of type 1, type 2 error, right? We are trying to optimize, in most finance cases, we are trying to optimize for not committing too many type 1 errors. But in the earlier stage you go, you are trying to optimize for not missing out on winners, right? So every single investment here has to look like a huge winner, has to look like it can make the fund, so to speak, right? And of course, many die along the way, but that's the nature of portfolio construction. But every single one of them has to look like they can return the fund. And so you will see bets sometimes on very random and very out of the world kind of ideas, but it is with that thought in mind, right? That they can give you outsized returns. So at this stage, the markets start to become very important. Like, how big can this be? Is a real question that we have to ask. By A and by B stage, and there's a clear distinction for me in terms of A and B. Not so much in the naming of the round, because you can name it anything. You can name it A1, post A, pre A, A plus, I don't know. But the point is, I think the difference between A and B is that at A, you may have found some level of product market fit, but it might be very early, or you may not have found that product market fit yet. But what's important is you show that you are on the way, or you are very close to finding that fit, because when you're down 1 year before, for example, your churn was this much. Today, your churn is much improved. That is some sort of evidence of product market fit. So by doing some of that, you kind of prove out a thesis here. By B, I think you need to have some sort of product market fit. You need to show that at least certain segments of your revenue drivers are profitable, or can be profitable. Maybe you don't want it, you choose it not to be. That's fair game, but can be profitable, and you're really going for scale ups here. And then C's and D's are just, you're just putting money behind further growth. You at this stage, maybe you are thinking about branching out to certain other business lines, but your key core market is already up and running. And you're probably a leader in one of the segments that you're playing in already. I'm just going to run through some stuff very quickly, because I think we have some time for discussion later. One quick tip to and you guys can take a picture of this if it's helpful to the audience. These are some of the things that I think as Series A, Series B investors we look at quite deeply. They have different points where we want to focus on. For example, if it is a deep tech company, or if it is a software company that's sorry, let me backtrack a little bit. If it's a software company that builds products for people to use in an office setting, for example, the SaaS companies, we want to focus quite a bit on the, for example, the technological review. As we want to make sure the solution is scalable, is robust. We want to make sure that the user experience is good, because what makes a SaaS company is essentially the product, right? And so we want to make sure that all these things looks good, especially at the A and B stages where you have some time to iterate on these items already. Traction metrics, yeah, we of course definitely look at this, but like I said, I think these are more hygiene. I don't think any VC here would make or break a decision based on traction or metrics alone. But it certainly opens up the discussion if you're going for a Series A and you're showing an ARR of 5 million. I think that's very attractive in this region, for example, with 90% retention rate. That's super. With metrics like that, I think anybody would look at your company with definitely closer. But for me, I think it's just something that we do look at, just because we have to just get a sense of where the company is at. But I think it's the second, third level type of metrics that we are looking at that's important. For example, there are many fintechs in this region, many lending related type startups in this region, and one of the high level metrics that everyone uses is NPLs, right? But what really is NPLs, and how do you calculate it? How do you use that in conjunction with write-offs? How do you think about 30 days, 60 days, 90 days NPLs? And what are the different relationships with all this? I think those are deeper level metrics that's more important and provide a more telling story to investors. So if your investor don't ask, of course, show it to them, because sometimes we miss things. And I think it's very helpful to have that open discussion. Yeah, this is just some generic template that I guess you can find it online. It's not unique to Qualgro, this part here. Again, same thing: competition, product, business model, team, financials. All these are pretty standard stuff that you should have in a data room. Spend a bit more time here, especially on this point on data room. I think for new startup founders, maybe it is something that's not as familiar to you, but essentially it is a place where you store all your critical documents that your investors need to assess on these items, right? And these are just some of the things that I typically look out for it differs from companies to companies. So some companies I just don't need, there's no segmentation in the revenues that it's driving. So we don't ask for that. But by and large, these are some of the things that I think are quite interesting for most investors to look at. Definitely incorporate your financial projections, not so much because we want to see whether you will grow 50% or 100% or 150% because no one knows. For me, it's more of understanding why you're raising the amount that you are raising. If you're raising 5 million, because anybody can go and say, I want to raise 5 million or I want to raise 4 million or whatever. But one risk that I see in this region is people don't estimate, don't give enough thought into estimating exactly how much cash needs they need. And you can never estimate completely, right? But you should at least give it enough thought, saying that, okay, in the next 12 months, I'm going to reach this milestone. To reach this milestone, I need these resources in terms of manpower, in terms of other resources. And these resources cost X amount. And if I add all of them up and I, take some sort of reasonable or conservative even revenue estimates, this is how much I would burn. And that's the amount. Maybe you buffer it a little bit and say that that's the amount I should raise, right? And it should be a realistic number, because if you raise too much, the danger is that usually what happens is that you inflate your valuation and then you have trouble, raising the next round just because of milestones that you are not able to hit. Right. So just some tips, I guess is probably a little bit useful for people. Definitely seek a lot of feedback, not just investors. People have to, the normal users will have to like whatever you are building and they are the ones that can tell you whether it's intuitively useful or not. As investors, sometimes when we use your product, we kind of use it with a diligence endpoint in mind, right? But somebody who's your friend or and the guy on the street, they would use it in a more organic and natural sense, right? Second point, I think, is standard, straightforward. Do your research on a VC. I think it's important. Know what deals he or she has done, what that particular VC has done. I think it's quite important, just to know whether you align and how you can position yourself to become more interesting, to fall into the mandate of that VC. Warm introduction helps a lot. If somebody whom I know of, respect, and there's a lot of good investors in this region, they pass something along to me and say that you should meet this entrepreneur. I always meet that entrepreneur, right? I think the last point is very important. Try not to be too disheartened by no's. It's a sales thing, right? You just have to go through with it, refine the process, be better at pitching, be better at understanding how to feel certain questions. I think those no's become a yes sooner or later. So yeah, that's my short introduction.
Yeah, so thank you, Wei Sheng. So perhaps now I'll stop the sharing and let Shannon share her slides from her side.
I can start sharing. Can you hear me?
Yes, we can, Shannon. Thank you.
Here we are. Okay. Oh, shoot. Can you see the screen?
Yep, all good.
Okay. Yeah, so Wei Sheng, hi everyone, I'm Shannon. Wei Sheng has covered quite a bit on the investment considerations that VCs go through. Maybe I can start a little bit about also sharing about MDI, our history, or our journey to our current form today. So MDI stands for Metro Digital Innovation, and it started in 2016 as the corporate venture arm of Telkom Indonesia. It's a conglomerate that is majority owned by the Indonesian government. It's involved in telecommunications, information, and media, and it owns Telkomsel, so it's the dominant telecom operator in Indonesia. So like Singtel, right? And has about 170 million subscribers, and that's just to give you a sense of their scale. So it's big. The fund started with 100 million and had a focus on investing into B2B companies with a global mandate. So we did do deals with Qualgro also, and Qualgro was one of the few other VCs back then that was doing B2B. We were focused on investing in Series A and B companies. So some of our portfolio companies would include Whisper, PayFast, Wavecell with Qualgro, Mobile Premier League in India. So we did around 40-ish investments and had a couple of exits. So that fund did well. So we had a few quick wins, and that gave the parent company confidence to top up the fund. So last year we announced that the fund had been topped up to 500 million and moved a little bit downstream to investing into Series C and onward companies. And part of that's also looking at potential M&A opportunities for the group. So for that fund, things have evolved a little bit. Alongside that, we had also been running an accelerator called Indigo since 2015. We should mention that there are many accelerators out there. We have one that a lot of Indo companies have gone through, such as PayFast, and that's really early and really Indonesia focused. We have also since set up a couple of other vehicles. So just because the main fund has moved a little bit down, we still continue to do Series A and B. So we have Centauri Fund, which is a co-GP with KB Investments in Korea. It remains a generalist fund. It's financial returns focused and invest in Series A and B companies. We also have a seed stage fund that we set up and we announced it, I think, earlier this year. It's called Arise, and it was also a co-GP with Finch Capital. And both these funds are anchored by the parent company, but they also raise external capital. Whereas for the main fund, then all of the money comes from telecom and other SOEs. And we're also the fund manager for TMI Ventures, which is a strategic fund for Telkomsel, not Telkom. And that one is strategic. So it only invests alongside them being able to find a business case or some way to work together with the startup before they invest. So I guess you can see how we have kind of gone full stack, and that's something that not just unique to us. A couple of other VCs have also are also doing that. So we cover all the way from accelerator stage to C to Series A, to B and C and onwards. Our IC for each of our funds is also composed of different people. So there is independence and really to avoid conflict of interest. But all of our funds sync up on a weekly call. So we have some visibility, except when it's very sensitive. So we have some visibility over what each other is working on. So say we are looking at something Series A and B, and it could be monitored by the later stage fund to cover later on. So you can see how we have evolved over time as a CVC in just a couple of years. As a CVC, we bring value to our portfolio companies where there are synergies. So we are financial investors, but we also invest strategically in some cases. And we have a synergy, a partnership team to help bridge the conversation between our portfolio companies and telecom or other SOEs. And this is regardless of the benefit is available to all our portfolio companies invested out of any of the funds. This slide. So SGI was asking us about how a CVC's structure differs from a normal VC. So when we first started at MDI 100, and this is all public information. So money was flowing from Telkom Indonesia to Telkom Metro and then to MDI, so from the balance sheet. And it's all reflected in Telkom Metro's annual report. So the corporate fund company and the fund manager are the same like an ordinary investment company. So it's really what you see on the left. But for more recent funds like Centauri, it's set up like the figure on the right in Singapore, and the fund is managed by its GPs. Usually one, in our case two, for Centauri, for TMI it's one. But aside from the co-GP thing, I guess people looking at it might point out that, okay, hey, it looks quite similar to how a VC is set up. And the structure basically mirrors an LP-GP structure where the GP manages the fund invested by limited partners. although we set up our funds as different entities, so there's one layer less, I guess if we have another fund as part of this co-GP, then we would have a master SPV, so there'll be another layer. But anyway, doing this, we get to enjoy the same tax benefits and exemptions as VC set up in Singapore. So structurally, you all can see that it can be quite similar to CVC, can be quite similar to a CVC. It's all a matter of how you set things up. Yeah, and I think this is the end of my presentation. How do I pass it back?
Thank you, Shannon. So maybe I'll stop sharing from my side. So I think now I can pass the time over to Benjamin. Benjamin?
Yep. Thanks, Jolie. Firstly, I want to wish everyone happy Lunar New Year. I think today we are very privileged to have very distinguished guests on the panel, some of the preeminent investor names in the region. And at SGInnovate, we have had an amazing opportunity to partner with some of these investors who are considered best in class. Often, there are many questions surrounding when to reach out, who to reach out, and who would be a good partner to have, given the relevance to each company and each investor. So we hope this session will be able to address some of that. I think ultimately, in our years of investing, we have seen that the goal of investors, CVCs and institutional investors alike, seems to align on being able to invest in high growth companies that drive value for the investors themselves. And what value means, I think, is unique to each investor. Just in a nutshell, some of our observations that I've seen is that, CVCs are able to provide technical validation and structurally, does the business work, and culturally, how much change management is needed within organizations who eventually may acquire such businesses or may want to work with such businesses. On the flip side, when we look at institutional investors, we notice that they are very good at ensuring there are proper governance structures in place for subsequent rounds of funding. There's operational discipline, and they are able to drive financial results, especially at the early stages of traction. So, against this, we have prepared a sort of high-level overview of discussion points, which we'll be reaching out to the fellow panelists to discuss and also to get their feedback on. And after that, we'll open the floor to questions. So I think before we begin on this set of questions, just a short introduction to myself. I'm actually the lead fund manager for 3 of our 4 investment funds at SGInnovate. And for the last couple of years, I've been investing globally at the growth equity level. So have a sense in terms of what is needed, but nevertheless, it's always helpful to work with partners like Sheng and Shannon, who are old friends of SGInnovate. So without further ado, I think the first point that I'm sure all panelists, I'm sure that all the audience are keen to find out on is this question is for both Sheng and Shannon, is that would you be able to share more on what are the strategic or the financial priorities for your individual investment firms when you evaluate opportunities?
Hi, should I go first?
Sure.
Wait,
please. Ladies first.
Oh yeah.
So you're asking about what VCs look at when they invest?
What would be your priorities when you consider investments?
What are the
priorities?
Priorities.
Yeah, that's right, priorities.
So it really depends on what stage the VC is looking at, right? So
Sure.
If it's a seed stage VC where there isn't much to go on, then the team becomes, the earlier it is, the more important the team becomes. As you move later stage, Series C, where the product's already on the market, you're already selling, then of course the traction becomes a lot more important because that shows how well you've executed. So I would say that all of that really depends on what stage you're at. But then of course, as Wei Sheng had covered, I think a lot of that earlier on. At the end of the day, we're also looking at how we can exit. So then we would first think about, aside from whether the team is strong, whether this is even a market we want to be in, and where we think we can exit, what the exit price is going to be. in order to decide whether or not to invest, whether it's going to meet the internal IRR that we've set.
Got it. And sorry, Rachel, you wanted to chime in?
Oh yeah. Actually, I echo a lot of what Shannon has said, but I think end of the day for institutional VCs like us, it's usually not an evergreen fund. In fact, I don't think any of us are. There's usually a fund life, which means to say that at some point you need to return the money back to your investors. Otherwise you're in breach, I guess. So with that in mind, the investments that we look at, I always ask myself whether I can make a good return in that amount of time spent. And I know that seems very Machiavellian in a way, but I guess the corollary from that is all those things that I mentioned about the quality of the founder. Is this something that we feel that with Qualgro's help, you can go from A to B, and then with Qualgro's help, we can bring you to C. Is this something that the market is large enough? So all these things are very uncertain, and all these things require a lot of, I want to say imagination, but it's also experience, because only with that level of experience that you can imagine that that's the potential future you can get to. So long story short, my overarching goal remains making a return for my fund in that allocated time spent. And to do that, I look at all these other things that I think are necessary to make those return. And those are the things that I've covered in the short presentation just now.
There are a lot of good businesses, but not all are businesses that VCs would invest in. You can be cash flow positive, so you're making money, but you're only growing 5-10% a year. Then it probably is not. It's a nice business to run, but it's not a VC investable business.
Got it. And for Shannon, I think this question is a bit more unique to you. Is that would you consider non-financial priorities when for example your firm makes investments? For example, whether whether the investment itself could be a channel for MDI to sell on, or your parent company, or whether there are, for example, like acquisition or even intelligence, that could be gathered just from investing in those companies. So I think the question surrounds whether they're non-financial priorities for the firm.
So I mean, like everything has value attached to it. So we're not going to put in money into something to lose money, right? No one does that. So when you put in money, we can either be like a financial investor, and then we get money out when there's an exit event. We could also have value, so and that's direct, right? But we could also create indirect value, say investing into something that would help the industry to grow. Or we can also create value maybe via some kind of partnership that is not going to have a monetary return to the fund. But that really also depends on which vehicle we deploy out of. So earlier I mentioned that we have a few vehicles. So something like that would be more likely to come out of the strategic fund, TMI.
Got it.
So it depends on your fund mandate, right? Even for VCs, it depends on their LPs and who their LPs are and what their fund mandate was.
Got it. Okay. Thank you. And I think that the next lead-on question is, probably example, which is, we'd like to let either panelists share perhaps what would be your high-level, thought process when you assess an investment at the first meeting.
Maybe I'll go first. First meeting, I'm trying to get my head around a couple of things. I'm trying to see whether first meetings are usually very short, right? It can be half an hour, 45 minutes, an hour. I cannot get anything I cannot make a decision in that first meeting, right? Especially for someone like us who are more Series A and B. There are more data points for us to look at. Maybe if I'm an angel investor, it's different. First meeting, okay, 5 minutes, first check out. But it's not like that. It doesn't work like that for institutional guys such as Qualgro. So for me, what I'm really looking for in the first meeting, and because it differs so much from company to company, I think generically I want to see whether there's enough for me to want to have a second meeting. And in general, it takes the form of a few things. Is this a founder that we can work with over the next 5 years, over the next 7 years? Because that's going to be the case. Although we will be diluted and we will not be part of the board later on and all that kind of stuff, But because we will likely be one of the first few institutional investors, that relationship carries through throughout the most part of your firm building, right? And to that end, a lot of the founder quality that we talk about becomes very important. Like, why do I think that you are the right guy to solve this particular problem? And I'm trying to look for clues to see, is there anything here that can tell me that based on his traction, and again, that traction doesn't have to be revenue, it can be anything, based on his experience, based on his personal motivation, right? Some founders I came across, they might be in the healthcare space and they're trying to solve a problem in a certain area of medical detection using AI, because some of their loved ones passed away from that particular problem, right? That particular illness, and that's a motivation from them. And then the kind of research they have done is so much, even from a layman perspective, it is impressive. So you know that this guy is very motivated, and that's enough for me to take a second meeting to see what he has to do with other aspects, such as his product, such as how is he going to think about building his team, such as what market is he going to tackle. That those questions suddenly become secondary. But for some other startups, especially those with more of executional focus, I think those questions become important. So in that first meeting, I'm trying to understand how big is this market? What is the use case that people will use this particular product? So as I go into each meeting, I don't have a set template in terms of what am I looking for? Like, I don't have a checklist that I'm trying to fill out. Instead, I'm trying to see whether there's enough for me to get to the second meeting, and it can differ from companies to companies. And that's why this job is a little bit difficult, because there's no template to do, as you guys understand. And so every meeting you're trying to think on the fly, okay, is there something here? Is there something here? And you ask questions around those things.
Got it. Shannon, would you like to chime in on this?
Yeah, I agree with Sheng. I don't think that the meetings have to be very different depending on what kind of startup you're talking to and what kind of vertical, what kind of industry they are in.
Right.
So a lot of things are on the fly. I really see it as an opportunity for me to get to know the company, but also for the company to get to know me. And so I'll be trying to learn as much as I can about what they're doing in the space, but also trying to get to know them as a person. It's when you're on face-to-face, be it in person or via screen, things are dynamic. You can go back and forth, and that's something you don't get when you're just changing information right via email. If you want to know numbers, they can send you an Excel file. You're not going to be able to. Usually, you can't remember everything or capture everything during a conversation like this. So it's very preliminary, as Sheng says, and then after that, learning more, digging more, especially when it's a later stage company, would come after that initial session.
Yeah, if I can just add one more thing, I think for most people, the way we think about raising funds or borrowing money or getting some sort of financing, we think of going to a bank, getting a mortgage, getting a car loan, is very straightforward. There is a template. Fill the template to the best of your abilities. You get a figure and you walk home with it. There is no arguing. Can I get more? Can I get less? Can I get a better rate? No such thing. It's very straightforward. So VC is the complete opposite of that. And that's why it's difficult to answer this question, what am I looking for in the first meeting? And that's why the best I can give is, I'm looking forward to the second meeting.
Great response. I think there's also a beauty in having an unstructured discussion. Sometimes there are surprises, pleasant surprises that come out of such discussions, which may not have a certain fixed set of structure, unlike maybe, for example, like private equity, where there are certain metrics that companies must have. I think the next question, is really on how would an institutional investor like Qualgro work together with a corporate VC like MDI. Just opening it to both panelists. How do you feel that both type of investors work together to support growth and to drive value in a way that is complementary?
Maybe I'll take it first, and then Shannon can chime. So for us, I think in general, okay, so here's the thing. I think most financial VCs at the Series A stage tend to want to take up the entire round. And it's not for selfish reasons, well, it's a little bit selfish, but it's not for reasons that are competitive. It's more for reasons that are that has to do with our own internal required rate of return, our own internal risk rewards, and we need to take certain level of shareholding to be able to have the investment make sense for us. Just a very quick example, right? If a fund is 100 million and they invest in 100 companies, having a small percentage each in each company is very difficult for me as a small VC with less than 6-7 investment team members to drive value on any one company, because it becomes your energy spread across so many different companies. So there's usually an optimal number that each of us try to focus on. And that optimal number necessitates that shareholding requirement. And that shareholding requirement, therefore, sometimes puts us in conflict with other VCs. Now, that's not always the case. Sometimes 1 + 1 = 3. And that's where we welcome other co-investors to co-lead with us or to co-invest with us. Prime example, this is a little bit of a shout out for our latest investments that we just announced today. We did it together with another institutional VC, and both of us usually do not co-lead deals just because we are very similar in nature. But the nature of that deal was such that we felt that 1 + 1 could be equals to 3. And it's the same thing with CVCs. CVCs bring with them a certain value that a lot of financial VCs do not. For example, they have insights into the particular industry that they are strong in. For MDI, Telkomsel is one of the largest players in companies in this region, right? Hands down. So they have a lot of insights into many things, not just you would imagine it would just be telecom related, but it's not. It's also have deep insights into consumers, for example, just by virtue of them being very ubiquitous throughout Indonesia, which is the largest consumer market here. So there's a lot of value in partnering up with a CVC in certain specific startups. So if a startup is in a space where the CVC doesn't have expertise, then I think I question a little bit of the value. But by and large, because in this region, in Southeast Asia, we are dominated by large, either government-owned or family-owned conglomerates, and they have a lot of say in how our entire economy shapes out. It makes a lot of sense to partner with CVCs just because they provide that industry knowledge that would otherwise be absent, and the startup would be struggling along, would be middling along, just because it can't break through certain barriers.
And I think I second that, from a SGInnovate point of view, especially in the areas of deep tech, whereby corporate validation, as well as their partnership with the startup provides a win-win situation for all. But Shannon, if you have any personal encounters of such successful cases, and in terms of how do you work with institutional investors to drive growth, we'll be happy to hear your views as well.
Some funds want to lead, so then when two funds always want to take the lead investor position, unless they are comfortable co-leading, then of course they won't be able to invest together. But then there are a lot of people who also just follow rounds, and then they don't take the lead investor position, then they can go in to a deal with a much smaller check with a lead investor such as Qualgro. We see some VCs such as 500 startups do that quite often also, especially for slightly later stage deals. For us, we are quite flexible. If it's a space that we are a lot more familiar with, then we are more likely to take the lead investor position. Otherwise, we are okay to follow also with a smaller check. And then with regards to value, right, I think and who to bring into the round and who creates value, a lot of it also depends on the startup and who they are comfortable to take money from, because a lot of times they would receive competing term sheets. And if they ask me what I think about the different VCs, I would give them my honest opinion, but ultimately it really boils down to who the startup wants to work with also. So I mean, not to us. Sometimes there are startups who actually the founders are super experienced, and they're kind of like, I prefer the VCs to not get overly involved and just let me focus on running the business. And then when they need very specific input or help, say with hiring, or if they need specific help with the next round fundraise, then they come in and ask for help. And you also see founders like that. So it really depends.
Yeah, I think coincidentally, MDI and Qualgro had a very successful exit in one of the investments that we made together, WaveCell, and that's a prime example. Yeah, and there's a prime example of, I guess, how VCs and CVCs work well together. WaveCell, by the way, is kind of like if I would put it away, it's kind of like a mini Twilio, right? And it's very telecom related. And that's where I think the expertise of the CVC really came through.
Got it. I think, and building on this point, really, on the WaveCell example, are there any other successful stories that you have to share whereby either of you have co-invested with institutional and CVC invested together, and what were the learnings from those successful investments?
So far, we have had another investment, not with MDI, unfortunately, with some other CVCs. There's a company that we invested in, based in Australia, has an office here called Data Republic. We invested with, so Qualgro, this was an interesting one because Qualgro was the only financial investor, only financial VC in the cap table. The rest were some banks in Australia, Singtel, SIA, some airlines, and so large corporates essentially invested in this particular startup. The name of the startup is called Data Republic. What it does data exchange in a very secure manner. There's a long story of it. The reason why there were a lot of CVCs, or in fact corporates, involved is because that particular product had a lot of value to those corporates around the table. Essentially allows for corporates to share data in a very secure, privacy protected manner that's very useful to both parties. And for Qualgro, our value is very different. Like, we obviously don't need that particular service, right? Because we don't have as much data as the corporates have. But for us, it's mostly from a strategic angle that we are involved. That's the reason why the company took us on, took Qualgro on, because I think we bring along some advantages as a strategic sounding board, some advantages in terms of market entry, some advantages in hiring and things of that nature. And it ended up being us being the only financial VC on that particular board. But yeah, I think apart from that, I think there are some others I can't recall on the top of my head now. I'm sure we have done many other deals with other CVCs before.
Okay.
Yeah, we've actually done a couple of deals and we've had a couple of exits. So that was Whisper, that was a communications platform that once listed on ASX. How we can help, it really depends. Depends on the startup. Sometimes, because startups are so small, we could give them bulk rates on something that normally would not be available to them and only to larger clients. Sometimes we could make them our exclusive partner for something because the market or the revenue that we generate is not big enough to share so many people. So then we give it to company we've invested into. Let me think. So we invest into a buy now, pay later company, and then we let them be the partner for our handset sales in Indonesia, because phones are quite expensive, right? So if you can pay in installments, then it makes it more accessible to people. So then they were the exclusive partner for that. And that one was done out of a strategic fund. So, even though it's a telco and people think that it has to be very tight, actually it can be something that's a little bit looser like that.
Got it. Okay. I think I'm going to open the questions to the floor now. We have quite a few questions in our list. So I'll let any of you take it first. When you look at, investments or even deciding investment strategy, Shannon and Wei Sheng, how important and how critical is sustainability and ESG factors when you shortlist an investment, given the current climate whereby, obviously sustainability is a very important theme.
I'll take that first then. For me, very important. For Qualgro as a firm, super important. And the reason is the following. While any given fund exists for 7 years, 9 years, 10 years, whatever the fund amount, the fact is that all of us in VC are trying to build longevity in this business, which means that after the first fund closed, very quickly you raise a second fund, so on and so forth. And hopefully, one day we will reach, I don't know, fund 16. And you don't want Fund 16 to look back at Fund 1 and say, oh, you did a couple of investments that are not good for the environment, and now you know your reputation is taking a hit because of that, right? So from a very selfish reputational standpoint, I think it just makes a lot of sense for us to invest in companies that embrace at least embrace those concepts. Now, as to whether we would invest in companies that deals with sustainability itself, or not embracing that as a concept, but is actually part of the business model, that's a separate question. So to that, I think it comes down to the same thing. Like, I will look at every other deal the same way, right? Whether it makes sense for me from a financial standpoint and all those things. But from a concept embracing perspective, I think it's important to us as a firm.
Got it. Shannon, perhaps you want to share that?
Yeah, we're Indonesian CVC, so you know, I think for most funds, what they choose to do would ultimately boil down to what ensures the fund's longevity, and how they can raise future funds, and so it depends on who the LPs are. And if ESG is something that a lot of the LPs are asking for, then and then pushing for, then it matters more and more to the funds. So yeah, it depends on who your LPs are.
Got it. So it's LP driven, and at times also
a lot of things will be LP driven, right? Even like diversity, whether you should
right.
invest into more female-led companies or minorities, it's also going to be push from.
I think this is an important factor. So for companies in such spaces who are looking for investment from that particular investor, I think, you know, just a totally separate point on the list of questions is for companies that are a bit earlier stage, perhaps, whereby, you know, the usual metrics of traction, be it from financial or operating standpoint, is not as clear. Say specifically at some companies that pre-seed or seed, you know, perhaps I think this one may be a bit more, I'll let Sheng go first, because this one could be more of a financial investment, very clear cut. How would you decide on the valuation metrics, and how would you approach these discussions when you want to reach alignment on valuation?
Okay, sure. It's one of my favorite topics when I discuss with founders anyway. Forget what you learned in Finance 101. DCF, multiples, blah, blah, relative valuation, doesn't matter. The way I think about it, and I think people may agree, may disagree, I'm not sure. But the way I think about it is a question of how much money do you need to hit your next milestones. Oh, okay. SGInnovate, you guys invest in deep tech startups, right? It's unlikely that you will hit profitability in Series A. In fact, it's unlikely that you'll hit profitability in Series B down the road, because you guys are investing a lot for the future, right? So any type of, you know, traditional financial type of methods of valuation is not going to work. But however, I still have seen people doing DCF for seed stage firms. It's quite interesting. But anyway, my point was more around, for me, it's about how much cash you need to hit that next milestone. And the next milestone should be defined by you as an entrepreneur, because only you should have the clearest idea of where you want to take your company. But it should be discussed in conjunction with the investors that you are bringing on board. They should agree, or they can, of course, influence a little bit, but they should agree that that is that milestone. And then all of us should agree that to hit this milestone, we should need this amount of money. And we don't over-raise, we don't under-raise. We raise enough, and then we give it a bit of a buffer, and then we give it a bit of tranching maybe to say that more cash if we hit certain milestones. But the point is, know how much you need before you go out and raise. And then from that, how much you need, have a sense of how much dilution you are going to give away. Then the question now is, okay, then how much dilution is the market norm? Again, market norm, but there is no hard and fast rule. This market norm, 30 to 25% at the early seed stage. Okay, let me play around a little bit. 15 to 25% at the early seed stage is probably where the norm is. As to why certain founders are able to give out less dilution, some other founders are give out more dilution, it's about de-risking. It's about sense of risk and rewards on the different VC side of things. Not all VCs are built the same. Some take more risk, some take less. Some view the same thing from different lenses. So as a result, it becomes a negotiation of what dilution you want to take. And then your valuation is a function of those two factors, right? A divided by B gives you C, which is the valuation. And then you think about that valuation, then you start, and as an investor, what I would do at that point is start thinking, okay, at this price, what does it mean for my future rounds? What does it mean for my exits? And if it still makes sense, then okay, fine, I'm okay to go with this price, even though it's high. So everything is, I wouldn't say it's all relative.
Got it. I think, Shannon, in capacity as a lead investor for MDI, how would you encounter and approach this discussion on valuation?
Valuation is really a negotiation, especially at such an early stage, right? There's going to be a range of values that we think as investors fair, and the founder is also going to think have a price in mind, and some considerations would be how much dilution the founder is willing to take, and how fast you want to move in the market, right? You can raise more, you can raise less, and then you get a little less dilution. And then for us, we can look at a couple of things, right? We can look at existing traction, especially since for us we invest more in growth stage companies. So could we look at multiples? Actually, you could even look at DCF, say for something like Rotimatic, right? So it depends a lot on the company and the space that you're looking at. And then from there you see, okay, this is the range I'm comfortable with. Does it overlap with what the founder is expecting? If not, then maybe we can negotiate a bit and see if there's something we can find a price that both are comfortable with. And I mean, there's a lot of ways to play around with it. You can set milestones, for example. You can create ESOP. So I mean, there's a lot of things that you could do so that you can make it something comfortable for both parties. But that's more for growth stage. I guess for early stage where you have a lot less that you can look at, a lot less metrics, then actually what we've seen is that it seems like a lot of seed investors start to defer making that decision. So then we see more and more convertible notes at the early stage. Right. So they decide not to price around, and instead they will take a discount to the next round that they expect to happen maybe in a year or so, because rounds get faster and faster now. So get a discount, or they will set a cap, so that they avoid making that pricing decision.
Got it. I think on this point of financial instrument, I think, Shannon, you brought up a good point. Sometimes earlier rounds could be in the form of notes or saves. Wei Sheng, what would be your recommendation to some of our attendees when they want to raise around, say, at pre-series A or the earlier stages, like even seed? How would they approach the instrument discussion, given that there's so many instruments out there, and some are obviously faster than others, and give up less dilution in the longer run? What would be your advice to founders?
First, understand the pros and cons of each instrument and understand what you need most at that point in time. I think it's hard for me to say one single advice, but I have seen certain companies that I really want to try to help and invest in, but they have more than 10 convertible notes stacked up. And at that point, it's very difficult for any institutional investor, because if you do the math, those convertible notes become very dilutive. And it's not a function of, and I can't save it even if I give it a high valuation, because it will be super dilutive. And as an investor going in, it's not, you would end up with a company where the founder has very little shareholding. You will end up with a situation where the safe notes or the convertible or the C note holders suddenly end up with a disproportionate amount of the company within the company. And at that point in time, what you can try to do is maybe a restructure of the C notes, things like that. I would say, however, if you are in sight of reaching a particular milestone, and somehow that you can hit it in the next quarter, go ahead and raise a C note. Go ahead and raise a C note from existing investors, right? Tell them, hey, I just need this much to bring myself to that particular milestone, and I can go out to the market and raise, and it will be very beautiful. Go ahead and do that. And it's very fast, right? And there's no, it should be very fast. Of course, it shouldn't be a protracted negotiation. Otherwise, there's really no point. But always make sure you understand the mechanism that how it will affect you down the road, especially when you stack up several of these notes, one after the other at different caps. Then that would be an issue down the road when you try to convert all of them at once.
Okay. Thanks a lot, Wei Sheng and Shannon. I think in the just looking at the time, I think we were sort of approaching, the end of this discussion. I think firstly we would like to thank both Shannon and Wei Sheng for joining us on this panel. And we hope the audience has found this very helpful. And beyond just a typical 101 primer on investing together with both VCs and CVCs in Southeast Asia. From our learnings even as investors, as strategic capital, we have found both sets of investors very useful to our mission to help deep tech startups scale from Singapore throughout the world. And we continue to work with both Qualgro and MDI to capture opportunity in this space, in addition to the many other investors that we co-invest with. And I think in the obviously the current situation that has happened throughout the past year through the pandemic has affected some of fundraising in different ways, but there always is access to such smart capital for companies who are willing to innovate and willing to adapt to the current environment. I would like to also pass the mic back to my colleague Jody, who will be able to then share us more on any the discussions. Obviously, pending the reception that we face, we may have a part 2. Given that I still have quite a lot of unanswered questions on the Q&A panel, but in respect for everyone's time as well. Over to you, Jody.
So thank you, Ben, for the moderation of our discussion points. And I shared earlier on behalf of SGInnovate, I would also like to thank Wei Sheng and Shannon for joining us for today's session. We also like to thank all the attendees for tuning in and staying. And even though we may not have answered all of the questions due to time constraints, I will definitely consider to maybe have a part 2 of this event series due to the remaining questions that we can cover in the future. And for our attendees, please also keep a lookout for our post-event EDM, which will include a recording of our event that is posted on SGInnovate's YouTube page. And we will also appreciate if you could drop us your feedback after the webinar and also join us at other events on our SGInnovate website. So once again, thank you everyone for joining us today and wishing you a great evening ahead. Thank you and goodbye.
Thank you guys. Bye.
Bye.